Welcome to the Wellness and Legacy Mastermind. We are here to connect death care professionals. And in this mastermind, we are collaborating towards our vision, which is to create a seamless connection between the wellness industry, which serves individuals prior to death, and the legacy industry, which supports individuals and families post death. What our group has recognized is that we often serve the same customers, often simultaneously. And so our group aims to foster a deeper understanding of each critical stage and collaborate as a unit, as an entire industry. The beautiful thing, if you've been to any of our meetings, we have been putting together what is the death care industry as a whole. And what we really determined is that there is a pre-planning side of the death care industry. Obviously, death is upon us all. It's definitely going to happen. So it's in our best interest to pre-plan. And that can be done through financial planning, estate planning, funeral planning, insurance planning, Medicaid planning. And then we realize that obviously, once your plans are in place, there's the natural aging process of what happens when we start getting older and things that our families are gonna have to cross through, like hospice and healthcare services and senior, real estate and moving around, right? And then the natural progression is post death. This is where, whether you planned or you didn't plan, this is still going to happen. There's going to be funeral, there's going to be probate and trust administration. And so what we realize as a group is that some of us are actually working on both sides of the spectrum. We're in the pre-planning and we're in the post-death. And so our group aims to really understand all of these facets. I do probate real estate, so it's very easy in my business that I can just stay in my lane and do what I do and not look to the left and not look to the right. But what we've noticed is now, as we collaborate, while I'm working with the family on the real estate, Peachie is working with them on getting beneficiaries paid out for insurance. Doug Wilder is working with them as they transfer the business onto the next generation, and so on and so on and so on. So collaboratively, we are becoming very dangerous as a group, learning the ins and the outs of the industry. This is a picture of our amazing group here locally in Ponte Vedra. So if you haven't been to one of our meetings, I highly suggest that you sign up. The next luncheon is on April 3rd, which is Thursday of next week, guys. So if you haven't signed up, definitely sign up. And we're going to be deep diving on these masterminds that we've had since our last session. So I think we're going to be speaking on pre-planning funerals, pre-planning with Medicaid, business transfers. So it'll be a really exciting meeting. For all of you that don't know, this is the amazing Jason Nunez. He is our lunch sponsor for the month of March. So thank you so much for feeding us, Jason. And he specializes in working with families that inherit property, but only one person wants to sell. So he will literally buy the shares of the families that don't want to stay in the real estate together. Very interesting. Get to know him. And then, of course, you have me, Carolyn Castillo, and Holly Schauer, your amazing host of this group. And we are guiding light to create a peaceful probate sales process for families when they're looking to sell inherited property. So without further ado, as we already discussed, we are here on a mission to figure out the death care space. We've already completed financial, estate planning, funeral planning, and Medicaid planning. Today is the one and only Peachie Thompson for insurance planning. I'm personally been looking forward to this one. And without further ado, I'll go ahead and unshare my screen. And I will welcome the amazing Peachie to the stage. Welcome, Peachie. Thank you so much for being here.
Hi, thank you, Carolyn, and thank you everybody who's here. I'm excited to talk with you all.
Thank you. So I actually got met Peachy through networking, and when I found out what she did, she's like, "Oh, well, we work in the same space because we work with families that are inheriting, that are preparing for, investing in their future and how to protect their assets and how to really work within the insurance space." And so since then, you've been a part of our group, and I'm just so happy that you've been along this whole journey with us. And today, you get to shine your expertise on everybody in the group. So, if you wouldn't mind just introducing yourself a little bit about your company, what you do in the marketplace, for those of you that don't already know you.
Yes, so I own Peach Insurance Services, and Peach Insurance is a national independent brokerage. I'm a general agent, which means I actually give contracts to agents across the nation for them to have access to products and insurance carriers. Peach Insurance Services, however, work with financial planners, fee only financial planners in particular. They work with us, we partner with them to take care of their clients' insurance needs. Insurance meaning life, long term care, disability insurance, and annuities. So, this will be my 28th year in the industry. So, I'm excited. I can't believe it. My my story is that I'm actually a first generation immigrant. My dad and I immigrated in the United States in the 90s, and I got a first job at a one of the biggest insurance companies in the U.S. and actually in the world, and that was probably the most awesome piece that got me started. Uh, Anyway, 28 years later, I'm still here. I remember the first training that I had for that insurance company. They would ferry me, from a helicopter. My boss must have been really awesome because he would have a helicopter pick me up in New Jersey, right in the parking lot, fly me to Massachusetts, where the home office was of this insurance company. And literally, I would have breakfast in New Jersey, lunch in Massachusetts, early dinner in Massachusetts. By 6:30, 7 o'clock, I'm flying back either in Manhattan or in Jersey. And, I was a teenager, right? I was 18, 19. At that time was my first job. And I thought that's how the corporate world was. So guess what? 28 years later, they don't do that anymore. Okay, they don't do that anymore. They tricked me, but it worked, right? The helicopter clearly worked because I'm still here doing doing what I love, and that's how I really got into this. And Peach Insurance was born out of love during the pandemic. I have been licensed since 1997, and really I've had many many clients throughout the years. And when the pandemic happens, everybody thought they were dying or getting sick or whatever. I had so many people come to me, so I just said, you know what? Let's go ahead and do it. So, yes, I serve everybody nationwide. Generally, you'll access me through a financial planner. However, I do serve, if you happen to stumble upon me or go to my website and you come direct to me, I am happy to help you. And we do have staff that's also happy to help. That's a long
Wow,
story, isn't it?
Peachy. That was a long but very fun story. My goodness. So you started the world getting on helicopters, and I mean, what a great start. I'm
I know,
surprised.
right?
Are you sure he didn't want to ask you to marry him or something like that?
No, I don't think so. I think it was just how it was back in the 90s. It was people were really given
Yes.
importance. People they thought would have a really good future in the industry. They gave the absolute best training that they could possibly get. And if that meant picking you up with the helicopter from one state to another and really having you interface with all the folks, it's just, I've met one of the most amazing people, actually not one, many, many amazing people at that insurance company's home office. And at that time in 1997, they had robots parading the cubicles, which was pretty awesome
Wow.
back in the
In
day.
1997. That's incredible.
Yeah.
Yeah, I know what you mean. Back, in the 90s, like the good old America, think people, employers, it was a different time, and so that's incredible that you got to experience that. And obviously, it made a lasting impact on you because your whole, career, stuck with you in insurance. So thank you so much. We're really looking forward to really getting some expert knowledge today on this subject. We are, primarily interested in how you work with financial planners. I think that's really going to be the key to really unlocking what is the value of, pre-planning with financial planner in mind, such as how life insurance, how long-term care, how annuities do really safe haven your investments and, create a successful aging process. Would you mind just kind of breaking down these separate categories? I don't know if you want to do it in any particular order, or how they kind of collaborate with each other, but help us to understand why financial planners pull in experts like yourself to safeguard themselves.
Yes. So the financial planners that I work with in particular are fiduciaries, and they are fee only, meaning they get compensated directly by the consumer. So if you don't already know this, there are many different kinds of financial planners. Some of them get compensated by commission. Some of them got compensated directly by the consumer. Some of them get compensated by both, right? So the combination. I can work with any financial planners really, but I chose to work with fee only planners only because I've done so many research, and I truly believe that it's a very good business model to have a financial planner that you can pay and say, listen, this is you're going to help me do this financial planning for the rest of my life, and they don't really care who they're send their business to, because they're just there for the planning. They're not getting paid outside of the planning. So whatever products they think should be in your financial plan, they truly believe that it is in your best interest. So that is my personal belief. Obviously, people have different beliefs. So the way we work is a financial planner would do your entire planning, how you do your where you put your money, your investments, and so on and so forth, and a lot of other things that they do. They pull in experts in things that they are not experts of, because they'll work throughout your life, not just your money. They're talking about taxes. Sometimes they're talking about not just your life insurance. They can touch base about your health insurance. They can touch base on your retirement planning and your investments and so on and so forth. So they cannot be the experts on everything. So what they do is they try to find people that they trust, who are experienced and experts in those things that they only know enough to be dangerous. So
Mhm.
I am truly honored when a financial planner would choose me, because they have a lot of choices in the country to work with. So financial planners, only financial planners, would seek out the best attorneys, the best tax planners, the best insurance agents that they think would serve their clients as well as they do. So that's how I mainly work with financial planners. Is they do the planning. I'm not a financial planner. I am an insurance planner. So we work hand in hand, and together we determine, does this client need term insurance, permanent insurance, disability insurance, long-term care, and some annuities sprinkled in there? Do they need that? And if it is part of the financial plan, my job as the insurance planner is now to match that client with the best insurance company best suited for them. Because I joke about this. You can think of me as a matchmaker. Like, I teach seniors at UNF. Right. So at UNF, I would tell the students, they're like, yeah, it's like dating. Insurance companies have their list of things that they want. You should have your list of things that you want, for your mate, right? For lack of a better term. So insurance companies, you need to pass those things before they will accept you. So therefore, it's not a one size fit all. Not, Joe Schmo could be insurance company A match, and Lynn Doe would be a insurance company C match, because of many things which we can dig into. I mean, I could bore you to death. I spent my background is in underwriting. I don't know if I mentioned that. I've been in technical underwriting for over 2 decades, and that's really how I got started in the business. It was in technical underwriting for life insurance, long-term care, and disability insurance, meaning I get to review all kinds of awesome medical records and financial records to see
Mhm.
if someone is a good risk for a particular insurance company.
Well, I
So
could see, yeah, I could see how, stop you right there for a second. I could see how you could be such a valuable asset. Like you said, there's financial planners have a lot of options out there of who to work with. But by having that underwriting background, because like you said, every insurance company, that's what for the novice people like myself, they don't understand that part of it as far as not every you're based on your makeup, your health, your situation. Certain underwriters are not going to take you or accept you. And I think having that level of expertise that it's not just generalized, but saying, hey, you specifically based on your criteria, these are the things that you're, credible for options. That's excellent. Break down for me before we go any further. Break down for me what is it that what does that look like when a financial advisor recommends you to somebody? What are the things what are they giving you to help you determine what long-term care they need, what annuity they need? What are these things? What is helping you to identify that?
So in the beginning, it's generally I call it a warm introduction. They introduce their client to me, and we talk about their goals in particular and what the financial plan in general looks like. We don't need to get into nitty details. We just need to get into they need some sort of insurance. It might be a combination of life insurance and long-term care, or they might need some disability insurance. So once I'm introduced to the client, the first thing that I do is I do my own pre-underwriting. So my individual underwriting, I become BFF with all my clients. They share with me so many personal stuff about their health, their lifestyle, their finances, all that is taken into consideration. Once I know someone's health, lifestyle, and I kind of separate the finances because we kind of put that to the side for the product selection or the product design, because underwriting dictates cost, right? So what most people make a mistake with is they think, oh, I can just go online and do a policy on my own because we can do that all the time. We can Google that and stuff like that. But underwriting dictates cost. So if you don't know who really would give you the best possible rate, it's tough. You're going to end up. I've had clients do everything online on their own, and then come to me and say, "Can you fix this? Because I made a mistake." So once we have that, we do our pre-underwriting in-house. We do a matchmaking, right? So this particular client is a match with this particular carrier based on the financial plan that the financial planner has designed. We have this much money to spend on insurance. This is the goal, and this is what we're going to match with the product. So they come hand in hand. You have the underwriting piece that would dictate your risk classification, which in turn say how much you pay in premium. I call it, if you have Superman rates, I call them Superman rates. That's the cheapest, right? If
Mhm.
you're a high risk, they will rate you a table A, B, C, D, E, F, G. The higher it is, the more expensive you get. A standard rate is just like an average person. Most people are standard. We have some things here and there that, have some medications that we take. So those are average folks. So with that, generally it's a pretty easy process. After the worst part really is sharing, because a lot of people don't want to talk about their health and their mortality. But once that's out of the way, it's pretty much everything is done electronic. Everything is pretty much seamless. There may be some, if you're looking for long-term care, depending on the amount of insurance that you're applying for, and life insurance as well. Insurance companies may ask the proposed insured for lab work. They may look for their medical records. So I get asked this a lot. It's like, what if I don't tell the insurance company everything? What happens? And I
Mhm.
say, that's a bad idea. Why? Well, think about this. Yes, you can omit things, right? And it's called fraud, and you probably don't want to do that. Let's say you get away with it. What's going to happen is there's a contestability period, especially in the first 2 years. Let's say you actually had a heart condition and you omitted that, whether by You completely forgot about it, or on purpose you didn't do it, and then you have a heart attack, a year later and actually died. What happens then? Do you think that your beneficiary would get the money if the insurance company finds out that there was indeed fraud in the beginning? No, of course not. It's fraud. Fraud's fraud, and then they will investigate. And in the contestability period, they have every right to deny that claim. So it is in your best interest as a client to share as much as you can with your insurance advisor, because your insurance advisor, they should be knowledgeable in finding out who is okay with your heart condition, who
Mhm.
is going to give you a a standard class versus a table D class with such a heart condition. And that is really the beauty of pre-underwriting, is to, yes, we'll have this tough conversation now, but listen, I am saving your beneficiaries, because you're dead if it's life insurance, right? You don't care anymore. Or maybe you do,
Mhm.
because you're like, you intended for that insurance to be for your heirs. So I'm
Mhm.
saving that headache now. We're going to nip it in the bud, and we're going to match you with the actual insurance company who would care a lot about you to give you the insurance that your family needs. I know, long-winded answer. Sorry.
Yeah. So let's pivot right off of where you're at. So let's zero in on life insurance itself, okay? So the purpose of this is really to talk about what are the pre-planning best practices, right? So when it comes down to life insurance, what are the things that people should be thinking through when they are, setting up a life insurance policy? What are some of those key things that we should be thinking about in setting up? Maybe when to take out a policy, age wise, how much of a policy to take out. Should we take out multiple policies? What are some of the best practices on that pre planning of life insurance?
Yeah, so on the life insurance piece, I would say that, so if someone asks, like, when is the best time to get life insurance, right? So I always say, if there's a single person, like those college kids would come to me, do I need to buy insurance now? Well, if you, the short answer that I always give is this: if you love someone or something, and at your passing they will have some sort of loss, then you should get life insurance, right? So that means if you're single and you have, let's say, a mom that depends on you for care, right? Because they're older, and you're the 20 something year old caregiver now, right? Or they have some sort of disability. You need to get life insurance, because at your passing, there's a loss there. There's a financial loss, and of course, the grievance is there. The grieving is there. So yes, the short answer is, when you can afford it and there is a loss that will be felt financially and also, of course, heartfelt, then that would be the time to do it. What age is that? So I would say that, that my answer is, when there is, whenever that is, right? You could be
The
21-year-old
need.
and taking care. But most people, when you have a job, you'll have some sort of group term insurance, right? And maybe you can't afford a private insurance. Now we're getting into the weeds of, there's there's group term, and then there's private insurance. So
Mhm.
they're two different things. People come to me as well, and we could probably talk about that in a little bit. But people ask me and say, "Well, I have work insurance. Isn't that enough?"
Mhm.
Well, that's great. Keep the work insurance. The issue with that is, if you quit your job, if you decide to move into another employer, or you get fired, so then you lose that, or you retire and you're not an executive. Most executives would usually negotiate for after retirement for some of these things. At least that's what I've seen. But if you're just an average worker and you retire, you lose all these benefits.
What about the group insurance, life insurance? Do they typically have, can you set it at whatever amount of insurance you would want, or they just set standard, like basically to cover funeral expenses and things like that?
Most group plans are driven by your salary. So it could be a one-time salary. It's capped. If you make $100,000 and you're capped at $100,000. Some, if depending on your level at the company, if you're management, you can be two times the amount of your salary. So now if you're making 150, you can get up to $300,000. And some of them, well, all of them are limited by whatever the company chooses. So if they choose one particular insurance company, then you have no choice but to go with their plan. So that's the other part is it is limited to what your employer picks, and it is limited by what you make.
Right. Was it recommended that people carry both? Because like you said, if you were to get fired or you were to lose a job or the company were to shut down, it's kind of something that it's great. It's a great benefit to have with an employer. So take it, but then at the same time, have that, private plan in place.
Yes, absolutely. So what I always say is, if most of this group term insurance are free,
Right.
meaning the employers actually pay for them. So
Right. Right.
don't say no to that. Go ahead, and I would say go ahead and sign up for that one. They're paying for it. The question always becomes, Peachy, do I buy through the employer? Because sometimes they give you the option to purchase more, up to a certain amount, or do I go private? And I say that let's look at the plans. Sometimes you may be able to just add a little bit of money in there and it still works out. But if you're looking for a higher death benefit, then most of the time the math works better if you go private insurance, because the risk classification that I was talking about with the underwriting, actually you can get Superman rates on the private insurance, whereas on the group rates you can't, because usually
Set in place.
uh, it is set by your group, unisex rate sometimes. So yes.
So what about so just shifting now to private insurance. If what in working with, somebody's pre-planning, they're getting their estate plan in place, they're working with a financial advisor, they have a net worth, right? Are you basing the insurance policy based off of their asset protection, or where is that, how does that come into play as far as how much insurance a person needs?
How much insurance a person needs depends on the goal. So if the goal is for to replace income, for example, so we have a formula actually that we use. The younger you are, obviously, the higher the multiplier is based on what you're making, right? So let's say an average person would work 20 years, right? Let's say 20 years, and you are in your 40s, so you'll still be there in 20 years. So, and you're making $100,000. So we could say, let's get 20 times your income. And generally you'll get approved for that, or 10 times your income is probably the easiest, right? So you make $100,000, so we'll apply for $1 million, because the goal of the insurance is to replace your income. So you have a family that depends on you, or you have, let's say, if it's for mortgage protection, now we're going to look at how much do you owe. So then, how much of this risk are you covering with life insurance? So if it's 300,000, then we go with that. The key is not to overinsure yourself, obviously, because there's 2 points there. The first point is the insurance company does not like anyone worth more dead than alive, right? You've probably heard some of those stories. Like
That's
there was,
good.
yeah, there's a high profile California attorney. It's on the news. He actually hired someone to kill his wife and his kid, right? It was unfortunate, which I believe they died, and then he got caught. He got tied into it somehow, and he was so remorseful. He decided not. That was for insurance money, because he wanted to get the insurance money for his own wife and his own kid. Well, if you're in jail, you can't really get that, right? You're incarcerated. So he was he got remorseful. He decided he's going to um, f- commit another fraud, which is have he hired a hitman to kill himself, right? But the hitman
Oh, you can't make this up.
only injured him. He did not die. This is real
I'm
life story.
gonna
You can
look
look
it
it up
up.
somewhere in North
Yeah.
Carolina. I don't remember the guy's name, but he did not die because the guy he hired for the job did not do his job well, did not kill him. Okay, so then
Didn't get it
uh,
done.
he didn't get it done because he wanted $10 million. I believe it was $10 million of his own life insurance to go to his the only living son, the one that he left, the one that was still alive. So anyway, then he didn't die. So then I believe I haven't followed it since then because I just kind of shook my head and thinking, yeah, see, you don't want to be worth more dead than alive because things like that happen.
Oh my
So
gosh, that's a hilarious story, and I love that
yeah.
tagline. That's a great one for insurance. You don't want to be worth more dead than alive.
Yes, yes, so you have like a bullseye right behind you, right? Your ex-wife or whatever. But so then let's say you're doing it for estate planning purposes. Now you're
Right.
talking about a different number here because there's also different levels of estate planning, especially when it comes to insurance. The average level of estate planning is just your average folk that really just wants to cover some things, the funeral expense, maybe some money leave for the kids here and there, some education, pay for the house, pay for all the debt and all that stuff. So that's awesome, right? You want to do the very basic. But we do have high level estate planning needs as well, right? That would be really more based on the state taxes. So now you're talking about the state tax laws, right? Where and I'm not an attorney or an accountant, I do work with a lot of them. And when it comes to those things, we take into consideration the full net worth, right? And the predicted, nobody can predict. Well, listen, you and I both know we're all going to die. Everybody here is all going to die, right? But we just don't know when. But and for good people, we should be paying taxes, right? So the two things that are certain is death and taxes, right? So when it comes to high level estate planning, we do take into consideration the net worth and whatever the current state tax laws are and the predicted state tax laws. And we do just like the example that I talked about. If you're only replacing your income for insurance, for example, we also have a formula that we use, and that is based on how big is your estate and again, what your goals are. So all of that are taken into consideration.
So I'm sure we can get really nerdy on this and keep going down a black hole
Yes.
just on life insurance. And I want to get on the long-term healthcare because that's a big topic in this group. But just one more thing. So talking about, a high net worth, and let's just say an estate, is worth, let's just throw out a number like $10 million estate. That estate is including, retirement, stocks, real estate, liquid assets, things like that. If they're in that part of putting together that estate plan and they want to have insurance that covers them, I guess that's the part of insurance that again is a question in my mind. If you have these liquid assets, you have these investments, it's not that you don't have the resources, right? Insurance in my mind has always been something that it's like if you need it, hopefully you never need it, but if you did, you'd want to make sure you have it. So when it comes to like you're talking about the average person that's like, hey, I have kids, I have a family, let me make sure I take out a policy that is, I think what you said was pretty much 10x of what your salary is, so and that would make sure that your loved ones are cared for and taken care of after your passing. But when we get into estate planning and we're, have this large portfolio of assets, what is life insurance look like in that scenario?
So a good example is, let's say you have a $10 million asset today. That's how much your net worth is, or all your assets are worth. And if you're thinking that your what we call the life expectancy is you have say you have a 30-year life expectancy or 40-year because you're young, right?
Who
Um,
determines that?
the life expectancy,
Hmm.
there's actually the chart we use in the underwriting world. We have a life expectancy calculator that you based on how old you are, we predict that you are there's a group of your age It's so grim. I'm sorry, guys. They're going to die by age, let's say 92. Maybe that's life expectancy for Carolyn because she is a standard average underwriting class. Now, if you were, let's say,
They take in your
your
particulars.
health,
Yeah, do they take
yes,
in individuals'
yes,
health into
yes,
the mortality
yes.
factor?
So,
Okay. Do
yeah,
they
so
share
we,
that information with the customer? Well, based on our underwriting, we determine you're going to be toast in 26 years.
yeah, I do it all the time. Yeah. So usually what I do, if you're a table D, I say that, listen,
Okay.
you are above average, meaning not in a good way, right? Like you're going to, sorry, so
You're on
clear.
the
My clients
you're on
love me
the
so much.
fastest
Like,
ship out of here.
well, you have a higher risk of passing away sooner than your average folk who was born in your era, right? In your year. So therefore, let's say instead of age 92, we're going to base our calculation on, let's say, age 85. So we're thinking that. So we have actually a calculator that says year after year after year, this is your predicted estate taxes. Of course, we can never predict what the government does with the estate tax and laws and whatever, but we can make as educated guess as possible. So generally, what that means is how I look at it is what your asset is today. You're gonna grow that by a conservative, let's say 4%. Some people would say 6%. I like to be very conservative and say, oh, the asset would grow 4%. And
Mm-hmm.
then the state taxes at that year is X amount. That's the prediction. That's how we know how much you should cover with insurance because it's very actually we're going to simplify it. Why do people use life insurance for paying estate taxes at death at these
Mm-hmm.
high level, high net worth level? Well, because if you die at that year and you have a certain amount of state taxes due because you have a huge net worth, you work really hard, you made a lot of money, right? So Uncle Sam wants his money, so you've got to pay the taxes anyway, right? You have because you're a
Mm-hmm.
good person. Everybody needs to pay. Even if you're not a good person, they're gonna want their money. So you either
Especially
pay
at death, it's kind of
it's
like you don't have an option. They just take it.
they just say, it's either dollar per dollar, meaning let's take some of your assets, liquidate it, and pay the estate taxes, or let's have your heir owe money to the bank, right, to pay the estate taxes, because your assets they can't touch it until they pay for it, right? So and it's 9 months after death the estate taxes are due. So liquidity is the first one. You die, the insurance company is going to give your heirs the insurance money tax free, so they're not paying taxes on those. Again, I'm not an accountant, but this is how it works.
Mm-hmm.
Tax free. Generally, if they're good, within 60 days, your heirs. So your heirs, they're grieving, they're heartbroken, you're dead, and then now they have this huge estate tax that's due in 9 months. The insurance comes, and say, here you go, just pay them and make it go away, right? So that's the first easy answer is they like liquidity. Second is
Mm-hmm.
the dollar per dollar. So um, if the insurance is acquired, especially when they're a little younger and we get them favorable underwriting classes, the estate tax that you pay is actually 50 cents to the dollar. That's an average
Mm-hmm.
person. So, okay. So you're like cutting your state tax bill in half, right? So meaning, let's say your estate tax is 10 million. Okay. And then you have a $10 million life insurance policy. Instead of taking 10 million from your investments, which by the way, you'll end up paying taxes, right? When you cash it out, you're
Mm-hmm.
just paying it with insurance money that's tax free. That was actually the premium on that probably was probably half of it. So it's like generally 50 cents to
Mm-hmm.
to the dollar.
Mm-hmm. Mm-hmm. That's phenomenal, Peachy. That is literally what I wanted to gather out of this, because this is what, this is, understanding, everybody understands the basic of life insurance and, but really how it interrelates into estate planning and high net worth and multiple assets and, just looking at it as a big picture. Thank you. I feel very knowledgeable, and I'm sure everybody on this call has appreciated that breakdown. You made it actually very simple now that you broke it down, and it makes perfect sense. Just the, knowing all of those intricacies of how things will actually play out. And I think that that's something that our group has been learning is, this is what people think is going to happen, but then when they actually pass, this is actually how it plays out in the real world. And being able to have that knowledge and then apply it to pre-planning is where the magic happens. So seeing that we're, 20 minutes, we're going to be out of here. I want to get right into long-term healthcare. Okay. This is something that comes up a lot in our group, and people are always saying, if they had long-term healthcare, it would have carried them through this time. Medicaid won't cover it, Medicare won't cover it. How does long-term healthcare play into all of this? Also with families that are, wealthy and, maybe probably don't qualify for Medicaid and those kind of things. How do they properly use long-term health care? Kind of along the same that we just did with life insurance. When should we get it? How do we know what policy to take out? Those kind of things. What are your thoughts on that?
Yeah, so the first question is when should we get it, right? So when should we get it?
Mm-hmm.
So I joked last year I hurt my back, in my 40s, and I said on my blog I was one activity of daily living away from having a full-blown long-term care claim, which was true because I couldn't I couldn't transfer in and out of bed. My back was killed. It was her, right?
Oh
So
my
the point is, I would say that 40 is the minimum amount. So long term care, I would say, is one of those things that when you start planning for when you're a little bit older, is when you should start thinking about it too. 40 to me personally is the magic number because that's the cheapest I could get it. And I like good bargain, right? I love to
gosh.
maximize my dollars, right? So at age 40, I'm still young, and the price of insurance, any long-term care insurance in your 40s is cheaper. I tell you, Carolyn, I have clients right now in their late 70s coming to me wanting long-term care insurance. It's a lot of money.
Mm-hmm.
But the first thing that you also need to think about is how much do long-term care services cost?
Mm-hmm.
All right.
Right.
So that's that gets taken.
I heard it's a pretty penny even at 40. Is that true?
I would say that yes, it's not, you can't expect it to be cheap. It is meant for covering the long-term care risk. So I look at it this way. We all are gonna get old if we don't die. That's the thing, right? And if you're paying for long-term care, this is the cost. There is a cost. So I always say, okay, when clients come to me, I ask, do you have kids? Why? Because like I'm Filipino, right? If not everybody knows that. So in our culture, our long term care, I'm the long term care of grandma.
Yeah,
Meaning she does
right.
never had long term care, right? Your family, it's a cultural thing. So even in the US, if you didn't plan for this, you're gonna be a burden to your great grandkids, to your grandkids, to your kids. And that's usually what the trade-off is. So is it a penny? Yes, it's not that cheap, but it's not that cheap to get care either.
Mm-hmm.
Does the math work? Absolutely. So, to answer your question, so we answered, I think early 40s is the best time to get it. How do you get it? Right? I would
Mm-hmm.
say you have to find an independent insurance broker that you trust. Okay. And I say independent only because I like having the option of going to any insurance company. Remember, we talked about matchmaking with the
Mhm.
underwriting? It's the same exact thing for long term care. You have a match out there and you can't be with one insurance company. It's just to me in my world, because I'm an underwriter by trade and I know too much about it, I just know that you'll have a better luck making sure that you are matched with the right insurance company. So you find that, and generally there's there's different types of long-term care insurance, right? So I call the traditional long-term care insurance, which is what you probably think about when you hear long-term care insurance. It kind
Mhm.
of works like your health insurance. It's inexpensive, and well, I shouldn't say long healthcare insurance is inexpensive. It was.
Yeah, I don't
But
think that's a thing anymore.
that's it's not a thing anymore. It covers. Sorry, I'm still thinking like I'm back in the 90s, right? So it covers pricing wise. It covers certain things, and it specifies what you're gonna get it for. But anyway, long term care, traditional long term care is the most inexpensive long term care insurance out there. The issue that people have with it is the premiums are not guaranteed to stay that way forever. And if you Google long term care and you have bad reviews and all that, that's probably because someone bought it back in the day, and then their premiums have increased tenfold, sometimes 20-fold, so they cannot afford it anymore. So it's still out there. You can still buy it. It's the most inexpensive kind you can get, as long as you're okay with the fact that, hey, it is not guaranteed that the premium will not go up. Then, if that's all you could afford, it's really better than nothing, right? But
Mhm.
most people, you're buying long-term care insurance because you want the guarantees, because you want it to be there. You want predictability. Most long-term care buyers are unpredictable income. So you have options to buy what we now call hybrid policies. And hybrid policies come in two ways. It's a hybrid, which is just a life insurance that has a long-term care component to it. But for all intents and purposes, it is designed for long-term care. Okay, and it functions as long-term care. And we have asset-based long-term care. That is basically it works like a hybrid. It's mostly sitting on an annuity, but it does have long-term care basically baked into the policy. So those policies are underwritten differently. Some of them would require a simple telephone interview. Some of them would require, and if you're getting a higher amount of long-term care insurance, would require for you to do an insurance physical where a paramedic would actually come to your house. They look at your gait, how you walk, uh, and how you talk. They give you cognitive tests, right? And this is my
Mhm.
clients' favorites. They tell me, Peachy, they tried to trick me. They gave me 10 words and then came back 5 minutes later and said, "Can you remember any of the 10 words and put it and use it in a sentence?" And I get all these reports. I love my clients, and it's a favorite, right? So sometimes they could ask that. Some of them would require medical records. There are products out there that do not require any medical records or exam, but a simple telephone interview with a cognitive test, done over the phone. So it just depends on the product that is best suited for you and what you like.
So, what the big idea with long-term care is that in the event that you become basically unable to care for yourself, you don't have the traditional Filipino way, right?
Mm.
You have to rely on the medical system. And, if you don't have long-term care, your medical condition can maybe bankrupt somebody. I mean, based on what assets they have. If you think about the average, retirement, person that maybe has $1 million in, their life, retirement, and they get hit with not being able to care for themselves anymore. Like, you hear it, grandma broke a hip and now she has to go to a nursing home, or she has to go to a full-time care, right? Because nobody's there to take care of her. How is it, how is it that it actually plays out in the real world? And is that where, estate planning highly recommends long-term care to help prevent that asset protection as far as not utilizing all of your resources in the event of a crisis?
Yeah, so the reason why you would want long term care in your portfolio is to protect the actual assets that you want to grow. So think of it this way. So if you have this, your portfolio of assets that you are saving, on the side, and you have a long-term care event, meaning you can't do two of the six of the activities of daily living, or you become cognitively impaired, right? So it's very easy to qualify for it, in the sense that you lose your mind, you qualify. Okay, you need the services. um, so in that case, if you were saving on the side and you did not have long-term care insurance, what do you do to pay for the services? You have to deplete those assets, right? You have to take money out of those assets. Doesn't matter what assets they are. They could be real estate. You need to sell the real estate so you get money, or it's the stocks. You got to liquidate your stocks and get money. So you that's how you pay for long-term care services if you don't have long-term care insurance. Now, if you don't, think of it this way: if you have long-term care insurance, that insurance will pay for the services, and your assets will keep growing. It will keep, let's say, this is most important for couples, right? Because people, husband and wife would say, we have $2 million saved. Okay, $2 million. I don't need to insure myself with long-term care because that $2 million is going to pay for it. Sure, let's say you are the husband and you actually need long-term care first. By the way, most men, not that I'm picking on you guys, Shep and Doug, always tell me, "Oh, I'm not gonna need it. She's the one that's gonna need it," right? But in my example, Doug is going to need it. Doug needs it, right? Doug, I'm gonna pick on you. So Doug needs it, and then his wife. Maybe Doug doesn't even have a wife. Sorry, Doug, but you have a wife in my example. Um, you have your $2 million portfolio. You need it, and you start depleting it $100,000 every year for 5 years, because a common long-term care event is about 3 years, right? If you have Alzheimer's, it gets longer. So let's just say you need it for 3 years because we're nice, and you died, right? Sorry, Doug. So 300,000 you took out of that 2 million, and depending on when you took that out of the stock, right? It's You're paying taxes on that, and then it's not. If your financial plan was to keep you and your wife financially sound until age 92, I don't know how old you are. You look young, you're like 50 years old right now, right? Um, yes. So it's not going to last to age 92. So you're taking it away from her, right? Because not only did you take $300,000 out, the interest that would have been for that $300,000 you started using for yourself, Doug. Okay. And then not only that, she's now left with less. Right. So that's to oversimplify things, but it kind of gives you the idea. You have this nest egg, you're gonna start pulling out of it. Not only are you pulling out for it dollar per dollar, versus if you had some sort of long-term care insurance, this can keep growing and it will provide for your spouse. Or if
Mhm,
you want some heirs, to want to give some to your heirs, you love some of your kids or all of your
mhm.
kids, right? Doug, you can't leave it there. So that's really why people like long-term care insurance, so that their financial plan would take them um, to where it needs to be. And the math,
That's a
oh,
yeah, that's a good example. And am I correct that once somebody would enact long-term care, it wouldn't be like someone would start using long-term care and get better, right? Long-term care is for till the end of your life. Like, you to qualify for long-term care, is it just for when you're ultimately, you know,
so
completely incapacitated, in the sense of that you need all these additional services, or is there a chance that someone can be rehabilitated and no longer need long-term care?
there are some. So let's say it's not your cognitive that goes away. It is, there's six activities of daily living, right? You eating, You eat, you bathe, you dress, continence, toileting, and transferring. Let's say you are one, you're healthy, cognitively you're there, but you had some sort of event that a medical condition that prevented you all of a sudden at your age 60 to your incontinence, your continence is done and you can't go to the bathroom, toileting is done. So that's two of the six of the activities of daily living, right? So you can have a claim, and you also need, forget about the insurance, you will need someone to help you go to the bathroom and bring you there and all that good stuff, right? So but let's say that that medical condition which was somehow fixed. Like I've had a client, now you have a catheter, right? So then you actually can survive, going around on your own. And then the continence was also with that medical condition was fixed. Then you can technically get out of a long-term care claim, but statistically that is a low chance. Most
Okay.
people who go on a cognitively, especially if it's cognitive, it's usually downhill.
Mm.
We haven't figured out a way to reverse cognitive impairment. Unfortunately, I would love for it to happen. um,
Maybe Elon Musk with his brain chips
Maybe
are
Elon
around the
Musk,
corner.
right? Yes. So, but there are some cases that you could go in and out of claim, but generally you don't. Once you start
Mhm.
losing the ability to eat, to bathe, to dress, and all that, it's kind of,
Yeah, it
yeah.
is what it is. Yeah. Peachy, holy moly, this was so informative. Thank you so much. We could keep going and just keep hearing your expertise. I love the way how much facts you share and then how digestible it is, for someone like myself that doesn't know the left from the right, when it comes to this. But I want to be respectful of everyone's time. If anybody on the call has a question for Peachy, I would love to give you the opportunity to kind of bring some of that to light. And as we kind of wrap up this, we are, Peachy, going to be creating a document based off of everything you shared with us today to really help our members to educate themselves on really the importance of these different insurance products. We didn't get to hit on the annuities, so we'll have to save that one. We'll have to put a pin in that one. But as far as the life insurance and the long-term care, you've really just, kind of just blown out the waters on it and helped us really to have a firm grip of what it really means, how important it is to pre-plan, and make us better as consumers, when we're out there in the workplace. And, I'm working in the probate, space, mostly post-death, I'm interested to hear how it rolls out. We are going to be having another series of part of the mastermind, which is how does insurance play at that post-death stage, so we would love to invite you to come back on and really kind of walk us through from the beneficiary's point of view. How are things actually covered? We touched on it a little bit, but there is a whole process in the post death. Did anybody have a question? I wanted to see everybody's good. Just wanted to, Doug, did you have a question?
A real quick question, Peachy. You said 40 was a good age to start looking at long-term care. Is there an age for when it's really it doesn't work anymore from an underwriting standpoint?
The oldest person that I got long-term care for was 83 years old.
Okay.
The
All right.
max
Very
is
good.
85. So 83, and we got all kinds of issues, but we were still able to get him something. So yes, I would say
Perfect.
don't give up just because you got old.
Thanks. You already killed me off, so
Oh, sorry, Doc. I just had to pick on you.
all right. I
I saw you
appreciate it,
smiling
Peachy.
there. Bye. You too.
You know what? The good thing about our group, and I've, personally, Holly and I have been meeting with everyone, individually and getting to know people. And everybody in this group is a real character. I got to tell you, they know how to have a good time. They know how to crack a joke, just to even be in the room and just people openly and easily talking about death, making jokes about death, in another circle, okay? They probably think we're the weird ones, but it's just so reassuring, to be able to surround ourselves with a community of people that, we can talk about these real issues. These are life issues. And I think us as you know, as people that work in this space, we're actually getting more comfortable with the conversations, you know, and as we get more comfortable with it, we can get more comfortable with our clients and also with our family, our communities, and we're going to change the world, guys. I'm really believing it. Okay. So thank you, Peachie, a million bazillion. We will be posting this video. We will be doing a whole write-up on Peachie of all the best practices that were shared today. So thank you everyone for being on the call, and we will see you on the next one.